Well, Morgan Stanley shares are trading lower this morning, even after the company came out and beat analyst estimates. This caps off the earnings flurry that we have seen from the large banks. And Marty Mosby is here to make sense of it. He's director of bank advisory and strategic services at Vining Sparks. Marty, it's good to see you. So when we look at the banks and we sort of try to take away what the themes have been for the banks, it seems as though some of the themes, of course, include that net interest margin that's been compressing, trading that has been challenged at many of the banks, although Morgan Stanley did pretty well with the equities trading. What do you think is going to be the biggest challenge for the banks in the second half of the year?
Well, the challenge is very simple. The challenge is this interest rate environment is as bad as we've seen, in the 40 years I've been in banking. So when we look at that, the components of why it's so bad is the fact that you have, basically short-term interest rates at zero. So you don't really get any spread off your deposits. So if you're a bank, you typically can make money on, accumulating retail deposits at a lower rate than the market rate. Well, you can't do that anymore. That's gone. And then what's happening is all this deposit surge is creating a hyper competitive environment for loans. So banks are out there basically trying to, backfill their balance sheets, trying to create some loan growth when there really isn't any loan growth. And the way they're doing that is really fighting on price. So the asset yields are now coming down. So we have basically, a medium steepness to the curve. Credit spreads are very tight. And that's really creating pressure on earning assets like we didn't even see back in 2015. So that's the biggest challenge, is dealing with this interest rate environment and the competitiveness for asset yields.
And Marty, you talked about that lack of loan growth. We were looking at some reports yesterday. Take Bank of America, when I went through, their charge-offs are collapsing, especially on the commercial side. And you sort of wonder, what else do they need to see to start extending more credit? Or is it just that there's not enough demand out there? How do the banks kind of get through this period where credit quality, borrower quality, clearly is quite high, but they just can't get people to lever up perhaps as they might need?
Well, the demand aspect of it is what really is causing the lack of growth. When there's so much liquidity in the marketplace, incrementally, folks and businesses at this point just don't need that incremental loan. So it's much more of a demand equation than it is anything else. Over time, what will happen is the asset price appreciation that we're seeing in cars and homes and businesses and commercial real estate will all kind of pull into the portfolios. So over time, the loan portfolios will have higher prices and higher valuations, which will create a higher loan growth without really having to do that many more loans. You just have bigger loans that come through, which reflect the infusion of money into the system. The other thing you have to kind of really focus on here is there's two cycles. And usually these cycles go together. You have credit costs and you have low interest rates when you go through a recession. What we have right now is credit costs that are going to be absolutely as low as you can imagine. So we have absolutely no pressure from the credit side of the bank, but we have an enormous amount of pressure on the interest rate side. So we're going to have pressure on profitability, but not any worry about survivability or what we're dealing with on the credit side. So very dichotomous answer, with the typical risks that come together are not happening this time. It's very separate in the way they're playing out.
Marty, I haven't heard one of the major banks this week discuss any of their plans on the cryptocurrency front, but we know most of them are in fact working on. JP Morgan and Goldman Sachs, from a trading perspective, Bank of America is developing a research function internally for crypto. Do you think this is just a niche industry for the banking industry, or it could move the earnings needle over the next decade?
No, so, you got to think, we have digital transactions with everything that we have. We have it on our phones. We have it on our credit cards. We have it in all the ways that we're going through the process. The cryptocurrency is just going to be a placeholder. You have dollars and you're denominated in dollars when you do those transactions, or you're denominated in some cryptocurrency in the future. That is a plug and play transition. What you're really looking at is these banks making sure that they still own the payment processing business, the blockchain, and what happens behind the scenes That's what's more important. That's what banks have, been the primary, provider of, is these payments. And they want to make sure that they're still controlling those payments. And that's what JP Morgan and other banks are making sure that they're going to be, caught up on. PayPal and Venmo and all this got way ahead of them. And that was scary to the banks. And that's why they came out with Zelle. And that's why they, rolled that out. And they didn't just roll it out for the couple of banks that developed it. They rolled it out for all banks because they wanted all banks to participate. That ecosystem of payment processing has really that's where you got to focus. And that's where the winners and losers will kind of shake out.
And then, Marty, finally, before we let you go, I just want to ask about the housing market, how that plays into, obviously some banks play more in mortgages than others, but just what dynamics we've seen there, how that could impact, whether it's loan growth or just the way that, that the bank balance sheets look as we go forward here. With obviously housing prices have appreciated, but we're starting to see maybe the pace of sales slowing down a little bit.
Well, this is going to be an interesting dynamic. One, mortgage banking was one of the real things that generated a lot of fee income over the last 18 months. You had a lot of refis. As rates drop as precipitously and as fast as they did, what you'll see is that mortgage rates will lag that process. So for about a year, you'll make outsized profits in your mortgage business, which is what we saw basically through 2020 and through the first half of this year. That part of it will begin to wane. But what's going to happen is that with the appreciation in home prices from 2008 to 2010, we had such pressure on the housing lending in the debacle that we went through that banks got out of a lot of the mortgage and a lot of the home equity lines of credit. Because of that, consumer finance companies have been doing great. Credit card companies have been doing great over this last decade because they filled that void. Banks, we believe, as they're looking for new sources for loan growth, one of the places they can go is being able to go back and reconsolidate all that debt and use the appreciation of the home to be able to let households be able to do that at lower interest rates. We did that basically from 2000 to 2008 as an industry and got a lot of loan growth and took a pretty big bite out of the, what you would call the consumer credit market. We think that's going to be one of the incremental loan growth areas where banks can begin to gain some market share.
Marty, just super quickly, 20 seconds. I mean, what happened in 2008 after they did that? I mean, is there any kind of risk of that kind of thing happening again?
Yeah, there's always credit risk when you go through this. But when you look at what actually happened, these loans performed very well. You saw Fannie and Freddie come out from under the pressure, and now they've kind of healed themselves. You look at those HELOCs and second mortgages, and everybody thought there was going to be huge losses experienced. The ones that underwrote and not the subprime market, but everything but the subprime market worked very productively, and that those loans were very healthy. So I think we saw the performance in the worst, and it was better than expected.
Interesting. Okay, Marty Mosby, good to catch up with you. Thanks. Director of Bank Advisory and Strategic Services at Vining Sparks.